With the rally in the U.S. markets getting a little long in the tooth, many investors have been focusing on Europe. So on that, let's take a look at the Stoxx 600 index. Now, this index represents large, mid, and small cap companies across 17 countries of the Eurozone. And as you can see, it's enjoyed a very nice gain since last November, but has given back a little bit of the gain recently. With a more market-friendly Macron French government in place and German Chancellor Merkel leading the polls, can we expect that bullishness in Europe to continue, or are there headwinds approaching from Italy? Joining me from New York is Bill Booth. He's portfolio manager and senior research analyst at Epoch Investment Partners. Bill, great to have you with us. And if you could, what I'd like to do is to spend a little time setting up just kind of what you see in the Eurozone and basically outside, a lot of places outside the U.S. And then I want to get into some investment-specific questions in terms of what you see is interesting. The G20 has just recently finished. It delivered to us all sorts of salacious political headlines. But did anything occur that was interesting to you from an investment perspective?
I think coming out of the summit, there's a strong sense that Germany and France are going to make a hard push to work more closely together to unify and integrate the Eurozone even more strongly, and ultimately try to increase Europe's power and influence on the world stage. And I think there's a couple of factors behind this. The isolationist policies of the Trump administration on global issues such as trade and climate are causing Europe to kind of look inward. And then certainly another impetus is the strong and positive French election results. And as you mentioned, Merkel's looking likely to win re-election come this fall in Germany. And so I think we could be at the very beginning of a real meaningful push to correct some of the structural issues associated with the Eurozone, and that would be quite positive if anything could be accomplished on that front.
What are you going to be watching? I mean, I know you said Merkel's leading the polls now, but anything that concerns, I mean, if something was to happen there, I mean, I would expect that it has some pretty profound implications for the Eurozone.
It could, but the economic data right now is just incredibly strong across the board. We're seeing a really broad-based pickup in economic activity across countries and sectors. I could point to a lot of different data points. Consumer confidence is at a 16-year high. German business confidence is at all-time high. Even French housing starts are growing 15% year on year over the last 3 months. Retail sales look good, and the ECB actually just raised up its GDP estimates for each of the next 3 years, and this is very atypical. We've become accustomed to downward revisions. So the economic picture is pretty strong, and I really think that the thing that we have to keep in the back of our mind, really, I think the risk event is the Italian elections, which probably occur sometime in the first quarter of next year.
So what is the risk there? Take us through what you're watching.
Well, Italy's the third largest economy in the Eurozone, so it's clearly important from an economic standpoint. And the real fear there is that the anti-Euro five-star movement will come to power and somehow orchestrate an exit of Italy from the EU. I think it's a highly unlikely scenario, although it's not impossible. And the reason I say it's highly unlikely is we just had municipal elections in Italy last month, and the five-star movement had a very, very poor showing. In addition, if the five-star movement were to win national elections, they would have to put together a workable governing coalition, and that's in doubt. Beyond that, it looks like a constitutional amendment would be required to even have a referendum on EU membership. And right now, as things stand, a majority of Italians want to stay in the Eurozone. So while not impossible, it looks highly improbable that the worst case scenario will unfold in Italy. But we have to be mindful of it. I think the good news is the timing of the election, while uncertain, looks most likely to be in the first quarter of next year, which means I think we have a period of a good 6 to 9 months in front of us where investors can kind of get back to focusing on just how good the economic situation is and get back to looking at improving corporate fundamentals, and we can maybe put the politics on the back burner at least for a little while.
I'm not going to let you put the politics in the back burner quite yet. I guess in the next 6 to 9 months, you mentioned you want to, I know, hear what you're saying, get some economic momentum. What about the UK?
So the UK, Brexit is getting worse by the day. We had the misstep of Theresa May calling the snap elections, where instead of strengthening her hand, she greatly weakened it. The data in the UK has definitely turned south. But I think the negative impacts of Brexit are going to be primarily confined to the UK because the Eurozone is more important to the UK than the other way around. About 40% of the UK's exports go to the EU. Less than 10% of the EU's exports go in the opposite direction. So while I think Britain is in for some tough times ahead, I don't think it's going to derail Europe or the broader global economy.
I want to shift, if I can, because I know that you cover obviously more than just Europe, and you take a look at everything pretty much outside of, I'll say, North America. So if you take a look at some of the emerging markets right now, what is interesting? What are you seeing right now there?
Well, in the aggregate, the emerging markets are improving, and many are benefiting from this pickup in growth around the world because many of these emerging markets are export-driven economies. One country that I like very much right now is India, where I think the long-term outlook there is quite strong. It's got some of the best demographics in the world. It's a very large and young population. And while GDP has been growing about 7% per year, there's still a lot more runway to go. Real GDP per capita in India is only 25% of that in China. And so there's lots of growth potential there. And while Modi came to office with a lot of hope and promise and fanfare, progress on the reform front has been slow, but we're starting to see some headway made there. We just had the goods and services tax implemented at the beginning of July, and this is the most meaningful tax reform in decades. And so I think India is on the right trajectory.
Before I get into names and sector ideas, just your take on what's happening with the U.S. right now. Are you concerned there could be a significant pullback in the next little while?
There's always the chance for a pullback, but I think the U.S. is on firm footing. GDP is growing at about 2%. Valuations, a lot gets mentioned about valuations, but I think they're still within a range of reasonableness. And people forget that more than 40% of the S&P 500 earnings come from outside the U.S. So U.S. companies are benefiting from this pickup we're seeing in Europe and the emerging markets. I guess my biggest fear would be the market could get derailed by, I think, a geopolitical event. So whether that would be armed conflict with North Korea, or if what's happening in D.C. right now turns into a full-blown presidential and leadership crisis, perhaps that would be the impetus for a pullback in the market. But I think the fundamentals continue to look pretty good. Yeah,
some might call what's happening in Washington right now an armed conflict, but I'll leave the political commentary till later. Let me get into some names here in terms of sectors and companies. Lafarge is something that you find attractive right now.
Yeah, so Lafarge Holcim is a global building products company primarily focused on cement. About 25% of their revenue comes from Europe, so they will benefit from this pickup in the economy that we're seeing, including a pickup in construction and infrastructure spending. It also has a significant presence in the emerging markets, where it has leading positions in markets like India, where I mentioned how great the long-term outlook is there, especially as it pertains to urbanization and the need for significant infrastructure development. There's also a cost-cutting angle. The company was formed by a merger of a French and a Swiss company 2 years ago, and so the company is still attacking the cost of the combined entity, and we think valuation is extremely attractive. Right now, it's trading at about a 7% free cash flow yield, but we see free cash flow growing quite strongly over the next few years, and we're going to be north of a 10% free cash flow yield if the share price stays where it is today. Importantly, about half of that cash flow right now is being paid in the form of a dividend, so we get a nice 3.5% cash dividend yield, and management is committed to returning essentially 100% of free cash flow once the company hits its optimal debt level, which we think will occur by the end of this year. So we could see a very meaningful step up in the dividend, as well as some share repurchases in the next 12 months. So I think there's a lot of ways to win with Lafarge Holcim.
And I should just tell people who are watching, if you're not aware of the importance of free cash flow to you folks at Epoch, they can go back and watch our other interviews where you guys talk about the importance of that. Coca-Cola, European partners. Why is this one interesting?
So this is a self-help story where boring is beautiful. So Coca-Cola European Partners, CCE for short, is a Coca-Cola bottler, and it was formed last year through a three-way merger. So the French and UK bottler merged with the German bottler, merged with the Spanish and Portuguese bottler. So management is really focused on reducing supply chain and procurement costs, and all of those cost savings are going to flow through to the bottom line into cash flow. Longer term, there's opportunity for revenue synergies with the sharing of best practices. The stock's on a 4% free cash flow yield right now, which doesn't sound all that cheap, but we think free cash flow is going to grow by over 50% in the next few years. And then that makes the stock much more interesting in our view if you can look through to what this company will look like in a couple of years' time.
Now, I know that I've talked to Bill, and of course, he's a big fan of technology, not just from but in terms of what it's doing to the investment industry and just the economy overall. But SAP, a big name everyone knows of, you like this one right now too.
Yeah, so S&P is the German tech giant best known for its enterprise resource planning software. And this is mission-critical software that runs the day-to-day operations of thousands of companies around the world. And it creates a beautiful business model because there's high barriers to entry, the customer base is sticky, and there's good recurring revenue. So the shares have done okay over the last couple of years, but I think they haven't realized their full potential because of a couple of near-term issues. One, like many tech companies, SAP is going from a traditional license model to a subscription, a cloud-based subscription model, and that temporarily weighs on reported revenues and profits and cash flows. But we think the lifetime value of a customer actually increases over in the subscription model. And secondly, the company introduced a significant upgrade to its product called S/4HANA in 2015, and the adoption and upgrade cycle has been slow to take hold, but we really think that's going to accelerate in the coming quarters and years. The stock's trading on a 4.5% free cash flow yield, and we have a high degree of confidence that it's going to grow its free cash flow at sort of the 10 to 12% per share range, which we think is very attractive and will provide the next up leg in the stock.
What about, I mean, we've seen a real rotation out of some of the big, the FANG stocks in the States in terms of people kind of, pulling a little money out, and of course it's bounced back a little bit. But are you seeing that with SAP? Are you seeing that with other tech names outside of the States?
SAP hasn't pulled back quite as severely. It's been more range bound, and I think part of that is a scarcity value outside the U.S. So if you were to look at the U.S. market and the European market, the tech weight in the U.S. is 5 or 6 times the weight in Europe, and so I think part of that scarcity value gets reflected in the fact that SAP has held up a little bit better than perhaps some of its U.S. counterparts.
Listen, I've only got about 45 seconds. I wish I had more time, and this isn't a fair question to ask you, but I'm going to ask you anyway with 45 seconds left. You've got a sector that you like, and this is OLED, which is, I think it's a display technology. Can you tell me just a bit about that, what's interesting to you?
So Universal Display, the ticker is OLED, is an intellectual property company, and they have a monopoly on the patents related to OLED display technology. So right now, most of our screens on our smartphones, tablets, etc., are LCD. Less than 5% of those screens are OLED. Over the next decade, we expect that there's going to be massive market adoption of OLED technology, and every one of those screens that gets produced, there's a royalty paid to Universal Display Corporation. So we think this is one of the best long-term stories in all of technology that we can find.
Wow, that's a pretty strong endorsement. Best names you've seen in technology.
That's right.
Bill, we're going to leave it there. It is always a pleasure. Will you join us again?
Absolutely. Thanks for having me on the show tonight, Kim.
Pleasure. Bill Booth, he's portfolio manager and senior research analyst at Epoch Investment Partners.